So you have a business and you should start treating your business as the third member of your family. In this video, I'm going to explain how, as a business owner, you should think about your business as a source of retirement income and how you should plan your finances around the business so that you can optimize the tax, your investment, and your insurance plan. So when you are starting a business, especially in the first couple of years, most people have a lot of doubt and there is no clear path on whether the business is going to succeed or not. So most people start business and first few years they struggle a little bit. In the third, fourth year, they have enough clients where their revenue is enough to make a profitable business. So the first thing you should do when you are starting a business, obviously you don't care about your retirement in that time of the year because you don't even have enough income to support your lifestyle. So when you have a very young business, always try to get life insurance, especially if you have kids who are going to be dependent on your income. So when I talk about insurance, I typically talk about life insurance, which are term insurance. Now, if you know a little bit about insurance, there are two kinds of insurance basically. One is permanent life insurance and one is term insurance. So the term insurance is going to give you coverage for 20 years, 30 years, depending on the need you have. Now, for most young business owner, term insurance will be more applicable. So if you're meeting an insurance advisor and they're recommending you a whole life policy or universal life policy, which are quite expensive and does not give you enough coverage, those products are relevant for your wealth, but not at the earliest stage of business. So when you are starting a business, get term life insurance to cover your income, and if you have a loved one, make sure that you are making them beneficiary so that if something happens to you, your families are taken care of. This is especially true if you are in the trades business where there is a high probability of getting injured or getting killed in work. So depending on your need, life insurance and disability insurance might be a good option. Then you probably will start making a little bit of money in your corporation, and you then will have to decide whether to take as salary or dividend. There is a great resources out there on the internet which will walk you through whether to take salary or dividend, but basically, in a nutshell, yeah, if you believe in CPP, Canada Pension Plan, then probably it's a good idea to take salary because then you can contribute to the Canada Pension Plan. If you're not a big believer of the Canada Pension Plan, then your accountant probably will recommend you to take income in the form of dividend. Talk to your accountant, figure out what would be the ideal situation. You probably need to find out what would be your income need for your lifestyle. So if you have a family and your annual expense is, let's say, $100,000, then talk to your accountant, see if they can do a combination of salary plus dividend or your salary. So it depends on the situation. And if you have a spouse who is also the owner of the business, then there is an option to give that other spouse a little bit of salary or dividend. If that person is actively involved, then you can do more. So that's another option for you. So at this stage, probably you will be taking money out from the corporation to pay for your lifestyle. Most people should do a little bit more. If the company is profitable, you should take a little bit of out to make sure that your TFSAs are filled. If you have kids, make sure to max out their RESP account so that you get the government grants. And at this point, tax planning becomes a little bit of issue at this point because you are making a little bit of money. How much you should pay out from the corporation, and if you are retaining income in the corporation, make sure to invest because you have to get used to think that the company will be your sources of retirement income. If you have a plan to sell the business to a third party, then as you make more money in the corporation and as you grow your business, think about having an external manager or some sort of manager who can be a replacement for you, so that you yourself, not the business. Because if you are the business, then you probably can't sell that business to a third party, because then there is no replacement for you. But if you have a business where the business is automatic, you just oversee everything, and you can replace yourself with a manager or a new owner, then that can be sold to a third party. So if you qualify for small business, then your company can be sold to a third party. Then whatever gain you have up to 1.25 million, I think that's the amount that they proposed in 2024 budget. So that's the amount you can get as tax free, meaning that if you sell the business and you have a capital gain of more than 1.2, you don't have to pay any capital gain tax on that gain, because you will claim the lifetime capital gain exemption. If you have the business with your spouse, then you can double that amount. And if you are very successful and you are able to grow your business and sell it for multiple $1 million, then there is option to look into family trust and holding company. But I'm not going to go that details in this video. But if you are successful growing your business, then sometimes a lot of people, what they do is they create a holding company where they transfer the money from operating company to the holding company and start investing in the holding company, because you don't want to keep your excess cash in the operating company because of the liability issue. Because if somebody makes a lawsuit against those operating company, those assets are also subject to claim. So talk to your accountant or financial planner. They will structure properly so that your holding company will be growing the investment and will be used as a source of retirement income. So what do you do with RRSP? Now, if you are a business owner and making a lot of money, it's really very less attractive to withdraw money from the corporation and then put it into the RRSP, because what you are doing is you're just switching from one place to another, but it's not changing your tax situation. Where we suggest that you withdraw money to fill up your TFSA first. Make sure to fill out the TFSA so that your TFSA can grow tax free. So if you become very successful and you need lots of insurance, because you get to a point where you have lots of assets in the business, and there is buy sell agreement that you need to do because of the shareholders, then there is need for other insurance in the corporation. But I don't want to go to that details. But in a nutshell, when you are a business owner, the problem is you can't do everything yourself. You have to surround yourself with a team of professionals where you can get tax advice, you can get financial planning advice, and you can get investment advice. So investment advice would be how you're going to invest all of your excess money that you don't need. So for example, your investment advisor will hold certain type of assets in your corporate account, where they might hold certain type of other assets in your TFSA accounts, because those two accounts are taxed differently. So your investment advisor, with the help of the accountant, will do that. Also, they will make sure that the market they're investing in is suitable for you. So they will talk to you, understand your risk tolerance, and based on your risk tolerance, they will invest your money. Whereas your tax planner or tax accountant will make sure that all the bookkeepings are done properly, all the deductions and expenses are claimed properly. Because a lot of time what we see is, when you are running a business and you are the sole owner, or you might have a spouse who are the sole owner of the business, you tend to pay a lot of personal expense through your corporation. So that's a nightmare for the accountant, because the accountant then have to separate those expenses, because Your personal expense cannot be claimed under your business expense because CRA might disallow you and then categorize them as a shareholder benefit. So you don't want to go there. To simplify your accountant's job, you want to keep your business expense and personal expense separate. Ideally, you should have a credit card or bank account which is solely for business purpose and solely for your personal purpose, so that when you file your tax return, they are categorized properly. And the last thing is, a lot of financial planners do not know the intricacy of tax planning. So sometimes it can be quite challenging to find an advisor who understands both the tax side, the investment side, and both how to grow your asset considering the business. So the bottom line I'm trying to say, when you are a business owner, focus on your business, try to grow your business, do the job that you are good at, and delegate the other stuff to the professionals because they're also running their own business. And when they do it for 50 other different clients, it becomes very easy for them to figure out what to do in your case. If you are a business owner and you only have one business, you got to learn whole new things if you want to do it yourself. You probably would be better off just to focus on your business and spend time growing your business rather than trying to learn a lot of tax knowledge and try to save a couple of $100 in investment management fees. As a business owner yourself, think about me trying to do your job. So that's all I have for today. If you are a business owner, I understand that you need a lot of planning. Find a team that is integrated, and I wish you all the best. And try to think about the business as your third member of the family. See you in the next video. Bye.